and welcome back to Catching Up on Capitol Hill, a series in which we discuss the latest in tax legislation and in tax policy. I'm your host, John Gimigliano. It's good to be back with you. It is Monday, April 14th here in Washington, D.C., and oh boy, what a week we had last week here in Washington between developments on taxes, the budget, tariffs, even action from Treasury on the regulatory agenda. So there's just so much to talk about in the tax policy world right now. But this week, we're going to do something a little different than we've done in the past with this episode. Just last week, Dan, and I recorded an hour-long webcast, and we thought we would repurpose that webcast for the podcast listening audience. So I hope you enjoy what follows. It's 60 minutes of tax policy goodness. We cover important topics in this episode, including some that are probably remedial to many of you regular listeners, like what is the tax cliff of 2025? What is the budget and budget reconciliation, and what the House and the Senate budgets tell us about the shape of their coming tax bills. But even there, our understanding of that process has deepened as things have gone along. But we also break new ground, like what taxes could actually be in play in a bill this year. And maybe most importantly for many of you, what is the timeline for all of this to happen? So I hope you enjoy this mega edition of Catching Up on Capitol Hill as we do our best to bring you the very latest as Congress tries to avoid going over the tax cliff. Greetings from Washington, and thank you for joining today's KPMG Tax Watch webcast. My name is John Gimigliano. I'm principal and co-lead of the Federal Legislative and Regulatory Services Group here in KPMG's Washington National Tax Office. Well, we've had quite a week here in the nation's capital, and I suppose probably wherever you are as well. So much is happening, and at such a rapid pace. I know it's hard to keep up with it all, but today we will try our best to get you current on the state of affairs in the congressional effort to develop and enact tax legislation at some point in 2025. Now, that process is still in its very early stages, so beware. That means we don't really have specific legislative proposals that we can break down or summarize for you, not yet. What we do have, though, is the process that Congress must follow. Now, look, I know that might sound a little bit boring, parliamentary procedure and all that, but here's the thing. Those rules, they really matter. They're substantive and real, and they will absolutely shape what the tax bill will look like, what's in it, what's not in it, whether new policies in that bill would be temporary or permanent, and honestly, whether the bill perhaps can pass at all. So today, as we talk process, we don't talk process just for process sake, I promise. We do that to hopefully outline for you what the coming tax bill might look like. So stay with us. Tax legislation, the real thing, it's coming soon, maybe very soon. And then we can talk tax technical. Until then, we're left to follow the road signs that the rules of budget reconciliation have given us. Our speakers today. Joining me to provide insights are fellow Capitol Hill veterans. We've got Jen Acuna, who is my fellow co-lead of the Federal Legislative and Regulatory Group here in Washington National Tax, and Dan Winnick, my friend and a principal in the International Tax Group, also here in Washington National Tax. Between the three of us, we have a history working for the tax writing committees in the House and in the Senate, Republican and Democratic staff, Capitol Hill, and Treasury. So I hope we've got all the angles covered for you today. Okay, let's go to the next slide and talk about our agenda. All right, we are going to start the discussion today with just a quick reorientation on what we've been calling the tax policy trifecta and what that means for what we're going to talk about today. But, just to remind you, there are other things happening off of Capitol Hill as well. They'll then move on a brief reminder of the tax cliff of 2025, what it is Congress is dealing with this year. And then to get into the budget process and the rules of reconciliation and why those matter to what this bill is going to look like. Then we'll break down the dueling budgets that both the House and the Senate have approved and what that tells us about a tax bill. And then we will talk tax proposals. Like I said, we don't have legislative text, but we certainly know some of the things that are going to be in play. We want to talk about those. And then, of course, finally, to answer, hopefully, the question that you're probably wondering, well, okay, John, if this happens, when is it going to happen? So we'll do our best to break down timing for you then. Okay, let's go to the next slide. All right, the tax policy trifecta. Let me just spend a minute on this because we've been talking about this all year. And if you followed the Tax Watch series, we've hit on all three pieces of the trifecta. Just to be clear, today we're going to talk about that one there on the top, the tax cliff and the potential for extending tax cuts or new tax cuts. We're going to get into that today. But there are other things happening. So we've got this ongoing issue of global reform also happening in 2025 and spilling into 2026. This, of course, is Pillar 2. And its ongoing implementation and the complexity that provides multinational taxpayers. That's happening at the same time, both here and abroad. And you're going to see that this meshes into one of the things we're going to talk about today is how that global reform meshes into the tax cliff legislation, potentially in the possibility of retaliatory measures. And then we've also got regulatory disruption. This administration has a very strong agenda as it relates to regulations. I would put tariffs in this category, although I suppose you could put them in the global bucket as well. But even this week, we saw the administration put out guidance that they are likely to pull back a number of existing pieces of regulatory guidance that we've gotten, perhaps without going through the notice and comment period. So the regulatory world, putting aside the legislative thing, the regulatory world is going to be really bumpy this year too. So it's not boring this year, but we are all going to be busy. Okay, let's go to the next slide. All right, just a quick reminder. Let's just orient ourselves again in the tax cliff of 2025. Now, look, I know this is a busy slide. Trust me, my team, we've spent so much time trying to put on a single slide a meaningful way to illustrate what is happening this year. So let me just spend a minute with you to talk about what's going on here. These items you see here listed are either set to expire at the end of this year or are already in the process of expiring, but they were all enacted back in 2017 in the Tax Cuts and Jobs Act. The ones that are light blue are in the process of expiring. You can see how many of those are lined up with 2025. At the top, you can see many on the individual side, individual rates, brackets, the alternative minimum tax, the standard deduction, child tax credit. As you can imagine, if you're a member of Congress, these are important things. These are things that voters care about. This is why Congress is so very motivated to deal with these expirations before the end of the year, before tax increases would kick in on millions of Americans on January 1 of 2026. But there are business provisions in here too, whether you're small or large. So if you're a multinational, there are things like the global intangible low taxed income that's GILTI, FDII, BEAT. These things have rates that are increasing. We've got the pass-through deduction for smaller businesses or pass-throughs. And then there are things that have already begun to expire. As you're probably well aware, we are in the period of time of capitalizing and amortizing your R&E expenditures. We no longer have 100% bonus depreciation. We're in the process of phasing that out. I think this year we're at 40%, headed to zero unless Congress acts. And we've got the interest limitation, the ability to deduct all your interest. That provision switched from an EBITDA standard to an EBIT standard, less taxpayer-friendly standard. Those have already started their expiration. So while they are not part of the 2025 tax cliff, they are absolutely going to be in this conversation. So this is the background which Congress is operating against. And extending all of these items will cost trillions, more than $4 trillion. And the question that Congress is grappling with is, do they pay for them? How do they pay for them? How long can they extend these? Should they extend them all? This is part of the debate that is going on. And this is where I say the process that is governing how they conduct this debate will tell us a lot about what's going to be in the bill. So with that, let me bring in my co-presenters today. There you are. And let's go to the next slide and talk about the reconciliation process. Jen, you're our Senate veteran. You lived through the Tax Cuts and Jobs Act. So reconciliation, the process, this is all important for the Senate. Remind us why it's so important for the Senate. And then, wow, there's a lot going on this slide. Tell us what we need to know.
Yeah, it's a dizzying slide, isn't it? It's almost as dizzying as the tax cliff slide. So reconciliation, the reason that we're talking about reconciliation is because usually when there is a trifecta on the Hill, so when you have single party control, House, Senate, White House, kind of opens the door for the opportunity for a reconciliation bill. And that is a Senate procedural rule. So what it does is it allows for budget reconciliation bills for them to pass with a simple majority. So you just need 50 because remember, the vice president would cast the tie-breaking vote. So with a simple majority in the Senate, you can pass a piece of legislation that is budgetary in nature. So that is why we talk about reconciliation. Otherwise, normally you would need 60 votes in the Senate to pass a bill through the regular process. And, to date, it's really hard to find, these large bipartisan bills. And also, these super majorities just haven't been happening in recent years. So when we talk about reconciliation, it has strings attached. So sure, you get to work around the filibuster, but it has to be a budgetary bill, and you have to go through all of the Senate procedural steps in order to unlock the process and allow that bill to pass through the Senate floor with a simple majority. So these are most of the steps. These are the steps that can be taken. Not all of these steps on this slide must be taken. Sure, they can skip over a number of them, but let's go through the ones that they have to. And I will note where we are today in the process, because Republicans on the Hill have begun the reconciliation process and begun to unlock that process for the Senate. So the first step, it's the most important step. Usually this is the easy step, but as my co-panelists will note, this has been pretty tough. This has been a tough year for that first step. And that's when the House and the Senate approved the same budget resolution. The budget resolution provides, basically the rules of the road for that particular bill. It sets the top line maximum increase in the budget. Remember, this is for a budget bill. So it provides that top line number by which you can increase the budget. Now, it has been a number of weeks where the Senate, the House, they haven't been on the same page with respect to that top line number. But just yesterday, that was yesterday, Senate, the House passed the same resolution that the Senate had passed a few weeks ago. So now we can check that box off of this reconciliation process timeframe. So now they both have the same budget resolution. What's next? Well, the first thing they have to do, and they don't have to process the bill through committee, but the committees receive their instructions. Part of that budget resolution, that outline of what's going to be included in the bill, it sets out specific requirements for each of the committees of jurisdiction. And in this case, tax, that would be Senate Finance or the House Ways and Means Committee. It tells them how much money they can spend in the bill. Tell me your budget, I could tell you what's going to be in the bill, right? It's a very budget-driven exercise. So they have received their instructions, and now they're putting together bills, which is step 2, when they put together the actual bill, not just the budget resolution, that will move through Congress. So then we have the committees of jurisdiction. They draft their pieces of that larger piece of legislation. And then they may or may not do what's called a markup process. That's when they process the bill in the committee of jurisdiction and then vote it out. And then it moves through, at least this is the House. First is the House process. We're assuming that the House is moving first because they are. And then the budget committee then consolidates. They roll that all up into one bill because remember, this is a budget bill. So budget really controls the procedure for the flow of the budget reconciliation bill. Then that goes through House rules. Then you have a vote. Now, this is an important piece. This is where you could see, at any one of these points. And I remember when we were looking at this slide, we were thinking, wow, there are a lot of steps. A lot of steps usually equals a lot of opportunities for delay, potential derailments of the negotiations. Both chambers have to ultimately, if you fast forward all the way to the end of the process, they have to both agree to the same piece of legislation. And that piece of legislation has to adhere to that first step, that budget resolution that they initially passed, that they passed yesterday. So there are many, many steps. They will have to reconcile, then the Senate receives the bill, and then they are going to have to decide, is this or is this not the same type of bill that can pass our chamber? And of course, they go through this process called the Byrd scrub. There is a Byrd rule that kind of hangs over reconciliation. And that's that's part of the Budget Act. It's one of the restrictions of reconciliation. They have a number of rules that they had to adhere to. One is that everything has to have a budgetary impact. Remember, it's a budget rule. There cannot be extraneous provisions. Everyone has to follow only committees of jurisdiction. Those committees cannot go beyond their jurisdictions in the bills. There are a number of matters that can be subject to this Byrd review. And so the Byrd scrub is basically when you get a bill ready for that next step, which is the litigation of those various issues. If there is an issue, relating to the reconciliation bill, they can raise a point of order on the Senate floor. Just a long way of saying they need to make sure they scrub the bill to make sure that it ticks and ties with all of the rules of reconciliation. But even after that process has concluded, the bill still changes over the course of the committees considering the bill. Then you can also have potential amendments to the bill where you can then also raise additional points of order. So there can be additional procedural hurdles and modifications that need to be made to the bill pursuant to that reconciliation process. So a lot of steps, there's always a lot of opportunity for, like I said before, delay and for potential, things can go off the rails, certainly. But it looks like right now, at least to date, that first step has been cleared. And Republicans seem very poised to try to move through this very procedural process rather quickly.
So, Jen, just to let people know that people in Washington, some do on Capitol Hill especially, do have a sense of humor. If something is removed from the bill because it's not bird compliant, it is referred to as a bird dropping. So just a reminder that, on Capitol Hill do have a sense of humor. But the question I get a lot is, well, the rule is 60 votes unless it's only 50. Well, why wouldn't you always make it 50? And I think you sort of outlined it. Using reconciliation is a very imperfect process for working around the 60 vote rule. There were so many rules, limitations, restrictions on what you can and can't do. Maybe one of the most important is that you cannot increase the deficit outside the congressional 10-year budget window, which is why so many, virtually all reconciliation bills lead to temporary tax policy, which is why we have the tax cliff of 2025 to begin with, right? Back in 2017, when you developed the TCJA, you had to sunset those provisions that I outlined because of these rules.
Absolutely. And usually the rule of thumb is that the sunsets have to take place in year 8. It is not a mystery why we're talking about this in 2025.
Right. Year 8, because some of these provisions have a tail, carry forwards, and that sort of thing, spill outside the 10-year window. So there we go. Okay, well, good. So that's the reconciliation process. Incredibly complicated, many opportunities to fail, but they have to navigate this to get this done with a simple majority, which is really the only way Republicans can move this bill. Okay, let's go to the next slide because, Dan, I'm going to bring you in now and talk about, so Jen said she said something that was interesting, that the House and Senate adopted the same budget resolution. Is that true, Dan? Because, yes, they did adopt the budget resolution, and now we're off to the races on reconciliation, but it's kind of unusual in how they did so. And this tells us something about how this tax bill is going to be shaped.
That's right. So this budget resolution was a little bit unusual. It started in the House, so it's originally a House resolution. And in the House resolution, they included only instructions for the House. So the budget resolution it doesn't contain the actual policies that are going to be in the bill, but it tells you what committees are going to be involved in the House and the Senate and what their budget is, how much room they have to play with, or what their assignment is in the bill. The House resolution only dealt with House committees, and it is a broad resolution. So in different reconciliation bills that we've seen over the years, there are differences in which committees are assigned. So in the bill that became the Tax Cuts and Jobs Act, that only dealt with, in the Senate, at least 2 committees, right? The Finance Committee and Natural and the Energy Committee. It was mostly a tax bill. This bill is could end up being much broader because many more committees were assigned. And so we're focused, because we're tax people, we're focused on the Finance and Ways and Means Committee. But you see that in both the House and the Senate, many of the committees of jurisdiction were assigned either to increase or decrease the deficit. Now, the House instructions, when you see a negative number on here, that means that that committee is required to reduce the deficit by at least that amount. So under the House instructions, for example, the Energy and Commerce Committee was assigned to reduce the deficit by at least $880 billion over a 10-year period. So that's a pretty big spending cut. On the flip side, the Ways and Means Committee was assigned $4.5 trillion over a 10-year period in potential tax cuts. Another way this resolution was unusual is there's a dynamic interaction between the committees. I think people who haven't been on the Hill underestimate how even when you're on the same team, sometimes there's a little bit of conflict. And one source of conflict in the House sometimes is the different committees really want to control their lane. And so often, it's a very delicate negotiation, what committee gets what. And committee chairmen often want to protect that they're going to get their piece and lock that down. This the House resolution contemplates that if the committee is assigned to reduce the deficit, can't reduce it by at least $2 trillion over 10 years, that the tax cuts that Ways and Means would get to do will reduce, so that the sort of overall fiscal impact of the bill stays the same. So there's this kind of back and forth dynamic. And so perhaps when the committees go to mark it up, meaning have their meetings to do their first draft on their pieces of the bill, each committee considers the pieces separately. If you get to go first, you can sort of say, well, I did my part, and then that kind of pressures other committees to do their part. And so there's this interesting dynamic about timing that goes on in the House bill. Now, most of what Ways and Means we would expect them to do here would be tax, because that's what they're talking about, but there are some other matters in Ways and Means jurisdiction that they may end up touching. So that's something else that we'll be looking on, like whether or not there are any trade matters that are touched in the bill, and certain health and unemployment matters. But we think it's mostly going to be about tax. So then we flip over to the Senate side. Now, when the Senate got this bill from the House, they said, that's great, House. We'll leave your resolution instructions intact. We're going to let you do your thing. But then they wrote their own budgetary instructions that don't line up so clearly with the House instructions. So there are differences in the committees in the House and the Senate. They have slightly different assignments about their subject matter. But even taking those differences into account, you can't look at the numbers on the left side of this chart and the right side of this chart and get to a bill that would be get to the exact same bill or the exact same policies. In the Senate instruction was also unique because the chairman of the Budget Committee at the time this resolution put out announced that he intended to use a current policy baseline. So the scoring that the Congressional Budget Office and Joint Committee have done for past reconciliation bills looks at changes in law from current law and what effect they'll have on the budget. And so the length of time that a spending or tax provision is in effect really changes the amount of the impact of that change. So if you do a provision for only 2 years, that's very different from doing it for 8 years. And of course, Jen and John mentioned that it is extraneous in the lingo of reconciliation, so not allowed to increase deficits outside of the 10-year window. And so that often led to expiring provisions, and that's what we've seen in most of the reconciliation bills, at least some expiring provisions in all the reconciliation bills that I can remember. And in this case, what they've said is, we're going to come up with a more realistic baseline, a more realistic starting point, and say that provisions that are to expire are going to be treated as if they extend, so a current policy baseline. Now, we don't know the exact contours of a current policy baseline because this current policy baseline hasn't been used for reconciliation before, and we don't know exactly how it will fit with those bird rules that Jen was talking about. So there's a lot of uncertainty about how this budget will be applied in the Senate. I think it's especially interesting to compare the finance number, which we have highlighted here, with the Ways and Means number. You see here a $1.5 trillion increase in the deficit over 10 years for the Senate Finance Committee. I think that's the same as what the instruction was in the Tax Cuts and Jobs Act. So it has some nice sort of fond memories for the Senate Republicans there. Whereas Ways and Means has a $4.5 trillion number. But if you applied current law scoring, so took into account Tax Cuts and Jobs Act extensions, and added on to that $1.5 trillion in additional deficit spending, we think, based on the estimates we've seen so far, and we're looking at different sources for this, we don't have an authoritative source, but we think that finance number actually would allow for fewer offsets or more deficit spending than that Ways and Means number. But the biggest impact of using that current policy baseline will probably be that it would enable changes in law that would be permanent instead of expiring after 8 years. So how that sort of evolves over the course of the process will be really important. And then the last thing I should come back to about these differences, because you're probably still asking yourself that how can these both be true? Well, there's a reason why Jen was talking about bird droppings in the Senate, the bird bath and bird droppings in the Senate, but not the House. In the House, the Rules Committee can waive the points of order, so objections to the bill. And so the House can proceed on it without Democrats having, or others who are opposed to the bill, in the minority opposed to the bill, having a clear path to object just because the bill doesn't satisfy the reconciliation instructions. These are sort of just a promise they make to themselves to follow these rules, but they ultimately can waive them on the floor. And when the bill comes back to them after the Senate does their part, they also don't have to follow their original instructions. And so the instructions on the Senate side are much more binding on what the ultimate bill will look like from a legal perspective than the ones in the House, because of the difference between how the House operates and how the Senate operates.
So let me, yeah, go ahead, Jen, make your point.
That's 100% right, Dan. So when you look at this budget resolution, you may say, look, these numbers, they're all inconsistent. Really, the Senate resolution is what is going to have to be defended during the Senate procedure on whether or not this bill qualifies for its resolution. So that's the one that, we kind of laser focus on.
Right. That, for practical matters, that's it. So what that means is a lot less mandatory spending cuts, right? That the House, you've probably heard, $800 billion out of Medicaid and all this sort of thing. Well, the Senate didn't agree to all that, right? And so it's unclear what the Senate is actually going to deliver on that. And that's why it was so hard to pass this through the House, because so many House members are saying the Senate's going to not actually do what they promised that they were going to do. But let me just hit the key point here. So in case it wasn't obvious, the Ways and Means Committee, the House of Representatives, can pass $4.5 trillion of tax cuts, deficit financed, without any pay-fors, right? Without any offsets. They've been given $4.5 trillion of free money, right, to spend here. And that's a lot. As we heard, the TCJA back in 2017 was only 1.5, so $4.5 trillion. But remember, simply extending the TCJA items themselves will basically consume that full amount. Anything else they want to do beyond that will be above and beyond that. The other things that the president has promised. We'll talk about those in a moment. Whereas the Senate, we've only got 1.5 trillion, but for reasons that Dan said, the way they're going to account for it, the current policy baseline, they're assuming that they don't have to pay for the expiring items, that $4+ trillion of the tax cliff, because it's current law. Well, why should we pay for that? We're just extending current law. We're only going to pay for new. And that's why, in effect, even though the Senate number is less, it's more, if that makes any sense. So welcome to Washington accounting, everybody. I know it's confusing, but this is the reality. And it was really a big deal that the House was able to convince itself to still vote for the budget resolution with this fear that the Senate was never going to be serious about delivering the spending cuts that the House Republicans really, really want. Okay. Anybody else with anything to add on here, or we can move on?
Maybe just one other thing to remember is the next step that we expect to see in the House will be each of these committees considering their part. And so that's a smaller group of members who have to agree. When we move on and combine the bills together and the House goes down to the floor to vote, that's all the House members agreeing on everything. And so it's a bigger group of members you have to get together. And so that's the reason why each step in the process is an opportunity for people to raise objections and for things to change. So just because you see something in an earlier stage of the process doesn't mean that'll be in the next step. And that can be good news or that can be bad news, depending on how you're thinking of any particular provision.
Yeah, and that reminds me, is one of the things we ought to mention, the sequencing in this is important, because as Dan said, that $4.5 trillion Ways and Means has been given to spend basically on the tax cuts can go down if the other committees don't deliver the spending cuts that they're committed to. And so you might think, well, I guess tax has to wait for everybody else to go so they know how much they have to spend. But the chairman of the Ways and Means Committee, Jason Smith, has said, no, we're not going to do it that way. I go first. I'm going to spend my full $4.5 trillion. putting pressure on the other committees to deliver, right? And if they don't deliver their spending cuts, basically he's saying, well, you go explain to President Trump why the bill is out of compliance, right? So it's a pretty aggressive move, but it's probably the smart thing to do from the Ways and Means chair to say, I go first, and I'm really going to hold everybody else's feet to the fire to deliver on the spending cuts. This is going to be the hardest part, right? The budget resolution coming up with that, in a way, that was, as Jen said, kind of the easy part. The really hard parts are ahead. It doesn't mean they won't get there, but it's going to be challenging. Okay, let's go to the next slide. All right, let's now talk about some of these tax proposals. You've all waited to get here. Okay, so we just want to run through some of the things that we are fairly confident are going to be in the bill, both what tax cuts we think could be in there, as well as possible revenue offsets. Now, on the offsets thing, let me just say this first. We're not trying to make news here by like calling out, oh my gosh, they're going to raise taxes in a particular way. That's not what we're doing. The things we've got on this list are well known. They've been announced by the committee. They've been in the press if you followed the tax press. There's nothing here new. Now, there will be things that are not on our list that we just can't know yet. But even though these are well known, these potential offsets, it's worth talking about them anyway, just so that you're aware of them, or if you're already aware, maybe we can add some light as to why or how they would do these. But let's start on the tax proposal. So we've talked about the TCJA extensions themselves. Jen, just a quick question. So I think you kind of alluded to this. They can extend them exactly as is. They can permanently, temporarily, but they could theoretically change the underlying policy in there, right?
They can. There's no restriction from, they're not restricted from not changing it. Actually, because the Senate is using a current policy baseline, part of the assumption is that if you just continue forward with current policy, which would be the TCJA extensions, that does not have a revenue impact. So they will arguably have to do something to cure that. That could be a problem in reconciliation. If there's no revenue impact, it is subject to a point of order. So yes, they're going to have to come up with some sort of revenue impact. So they're going to have to make some changes along the edges of these provisions, but they're also going to have politically driven modifications to those existing TCJA extensions. The one big one that jumps out at me, just looking at those possible revenue offsets, its individual companion is the individual state and local tax deduction. That is capped at $10,000. That $10,000 cap, it expires at the end of the year. So arguably, if they wanted to extend everything, they would also be extending that $10,000 limitation. However, we know that politically, they're going to have to go in there and make some adjustments to that limitation due to political considerations.
Yeah, that's a really good example of one that is going to have to get done, because there are Republicans from these high tax states are saying we need a higher cap, and it sounds like they're prepared to make some changes there. Okay, Dan, let me ask you about the manufacturing incentive thing. This is something that the president talked about on the campaign trail. What do we think this is? Do we know what this is?
So this is a really good question, and something we're getting questions from a lot of clients about. I don't think we have a clear idea of what the manufacturing incentives are, but there are a couple of possibilities from history that we could be looking at. Under prior law, there was a deduction for domestic production, old Section 199 that many of you are familiar with, and that could be a way to achieve a lower effective rate on manufacturing for corporations, and kind of serves as a companion to existing Section 199A for pass-through businesses. But Section 199 existed at a time when we had a much higher corporate rate of 35%, and it might not have been targeted on the exact activities that they're interested in incentivizing this time. And so, although Section 199 provides a mechanic, it might not tell us exactly what kind of manufacturing they intend to incentivize. And so that will be, I think, in one area where stakeholders can say, provide them distinctions and help them focus on what's an incentive for manufacturing. Another idea that was floated this week was whether we should have some sort of export subsidy to go along with the tariff and trade policies that the White House has implemented over so far this year. So perhaps another area where they could be looking are some sort of export incentives. We already have in the code from TCJA the FDII provision, foreign derived intangible income. Perhaps this would be something looking at more tangible goods. So those are two potential incentives that we're looking at.
And I'll add another. I mean, when you talk to Capitol Hill staffers, they're saying, look, we think this is all about bringing manufacturing back to the U.S. This incentive has to do that. Inquiry whether or not those other two ones is narrowly targeted at that. So one other idea kind of percolating is extending 100% bonus depreciation. So let's assume they extend 100% bonus depreciation, but extending that to structures. So currently, structures are not bonus eligible, but extend that to structures as long as that structure is involved in manufacturing. And you look at that one, you say, well, that sort of does sound like something that is very specific to building a new factory. So to your point, though, Dan, I think they're still grappling not only with how the mechanics of how to provide this, but even with what manufacturing is. The old 199 definition, that was an old one, right? That goes back to 2003, 2004. The world's changed a lot since then. So query whether or not they would come back to that, or they're open to new suggestions on how to define manufacturing. Okay, Jen, boy, these other ones that the president talked about,
Oh my.
overtime, Social Security, they're all very inexpensive, right?
Oh, sure. No, nothing popular is inexpensive, John. We know this. But, it's fascinating the way these have kind of evolved over the course of the last year. As we all know, during the campaign trail, President Trump talked about an exemption on income tax for tips, for overtime, and for Social Security. Now, we know that the tips in particular, that was something that was picked up on a bipartisan basis. As soon as, 24 hours after after President Trump was talking about that during the campaign trail, the Harris campaign also picked that up as one of its campaign proposals. So there's it's a very popular provision, a very popular proposal. So we know that Capitol Hill and congressional Republicans are certainly prioritizing the tips in particular, some sort of an exemption on tips. But it's like everything, it's really going to be budget driven, especially in these, reconciliation bills. They probably have a specific amount of money that they are allocating to spend on the provision, and will modify the exemption to tailor it to that budget. Overtime, similar. It has not been as popular. We haven't been hearing as much on a limitation on overtime tax. Social Security, that's one that, kind of runs into procedural issues with the Senate reconciliation process. One of the limitations in reconciliation, pursuant to the Budget Act that created the reconciliation process, is that the provisions in the reconciliation bill cannot impact the Social Security Trust Fund. Fun fact, the taxation, you may say, well, Social Security, it's taxed, that's an income tax. That goes into the general fund. That doesn't affect the trust fund. Not the case. A portion of the tax that's imposed on Social Security, pay on Social Security benefits, actually goes into that Social Security Trust Fund. That creates a bigger procedural headache for the inclusion of this provision in a reconciliation bill. That's viewed as a fatal flaw. That would not allow the bill to proceed. They would have to strip that out immediately, or just not include it preemptively in order to safeguard the integrity of the rest of the bill. So that one, certainly popular, but also going to be procedurally impossible in the reconciliation process.
Okay. All right. So great questions are pouring in. I'm trying to keep an eye on them. We're going to get to them, I promise. So let's take the next maybe 10 minutes to talk about the possible revenue offsets. Again, let me say, don't get mad at us for mentioning these. These are out there, very publicly acknowledged by the Hill, is in play. So let's talk about them anyway. So Dan, let me start with you. When we talk about discriminatory retaliation measures, discriminatory tax retaliation measures, what do we mean by that?
So discriminatory tax retaliation measures, this we've seen both action from the White House, and we've also seen bills proposed in Congress that look at taxes imposed by foreign jurisdictions that the United States views as either discriminating against U.S. companies or taxing outside of taxing income that's not earned in that foreign country. So kind of beyond residence or permanent establishments in that country. And the ones that have been called out are for discriminatory taxes, digital services taxes, which often have a revenue threshold that ends up catching just U.S. multinationals, and Pillar 2 UTPRs, so the kind of rule in the global minimum tax that would subject potentially U.S. companies to tax because the United States does not have a domestic minimum top-up tax under Pillar 2. In response to that, there have been two proposals that have been introduced so far in the House. One is based on an existing law, but it kind of modernized it, and it would add 5% to the withholding tax and effectively connected income tax rates for each year for 4 years. And it also purports to turn off tax treaties for countries that, for these income streams for countries that impose discriminatory or extraterritorial taxes. Another proposal would modify the base erosion anti-abuse tax, the BEAT, that was put into the law in 2017 as part of TCJA, and make it apply to countries that are to companies that have a company in the group that imposes UTPR. And this expanded version of the BEAT would both apply more broadly by eliminating the base erosion percentage test, so a kind of de minimis tests about payments outside the country. And it also impacts, and another major impact of it is that it would treat half of COGS as if they were base erosion payments and not deductible under this minimum tax. And it has some other provisions as well. And so both of these provisions would be very adversely impact inbound investment into the U.S. Both have been co-sponsored by nearly all the members of the House Ways and Means Committee, so it's gotten a lot of attention there, and that's how we know that it's something that they're looking at.
Yeah, it's definitely something they keep talking about, and it is very much targeted at pushing back on Pillar 2, right? You know, the Republicans have not been happy with Pillar 2, and this is part of their strategy to try and, by taxing those foreign multinationals, I guess the idea is that those multinationals will go back to their home country and say, let's leave the U.S. out of, things like the under-tax profits rule and that sort of thing. So we take that one very seriously. Let me take the next one, then Jen, I'll ask you to take sea salt. So the Inflation Reduction Act, as you probably know, enacted, so many new energy credits, dozens, some of them very novel, some just extensions of current law, some new features like the ability to transfer tax credits or convert tax credits into direct payments. 0 Republicans voted for the IRA, and they were pretty clear that they didn't like it at the time. President Trump repeatedly on the campaign trail said it was going to get repealed, and Republicans have taken that up and saying we're going to repeal parts of it anyway. Now the question is how much, because as many people will note, a lot of this investment has gone into Republican states, and that's true. And so I think that there are some components of the Inflation Reduction Act that are likely to survive. In fact, Speaker of the House Mike Johnson said we're going to use a scalpel, not a sledgehammer. But at the same time, I don't think they're all going to skate through. And so the other question then is, how would Congress transition out of the existing rules? What they don't want to do is retroactively raise taxes on anybody who just happened to avail themselves of these credits, relying on the law as it is. That wouldn't be fair. And so they're looking at ways to say, if you've made an investment, if you've got legal commitments in those investments, we'll respect that, but going forward, no more. And I think that's where we're going to end up. Exactly which credits are at greatest risk, hard to say right now. But I do think they believe they can raise a substantial amount of money by pulling back on some of those Inflation Reduction Act era energy credits. Okay, Jen, sea salt reminds everybody of the beach, but it's not quite as much fun as the
sea salt. It is not the vacation you expect. It's a little bit of a potential nightmare for those on the call. But so sea salt is a short term that we use to describe the potential proposal to limit the state and local tax deduction, but with respect to corporations. So a very interesting proposal, very impactful. And it was kind of derived from the idea that since individuals are limited in their ability to deduct state and local taxes, why don't we apply the same limitation to corporations? That's kind of that's what we've been hearing. That was the rationale. Right now, that has been floated as a potential way to offset or pay for any taxpayer relief that is provided on the individual side. Remember, we were talking about, the political need to provide some sort of taxpayer relief or an increase in the state and local tax limitation for individuals. Usually when you have these revenue raisers that we as we like to call them, they try to match up like with like. And in this case, they're matching up, an imposition of a new state and local tax limitation on corporations. They're trying to match that up with providing taxpayer relief to individuals who are subject to the state and local tax limitation. So an interesting proposal. I mean, the one thing that I will note from a policy perspective that is much different than in the individual space is that corporate SALT is not as geographically succinct as individuals, right? We know California residents, they pay tax in California. Corporate SALT is not calculated in the same way. So it's a bit counterintuitive that it would not necessarily only hit high corporate SALT states. So that's something that, politically they're going to have to grapple with as they consider potential ways to raise money in order to pay for other portions of the bill.
Yeah. It's going to be really interesting to watch because you're right. The political dynamics are so different than the individual SALT cap, where you could be from the reddest state, a corporation in the reddest state in the country, but you're paying tax in all 50 states. You're not going to be happy with this. And so whether or not this one will survive, we don't know. But they've talked about it quite a bit, and they're definitely thinking about it, how to draft this, sea salt limitation. Would it be limited just to income taxes? Could it expand to other taxes? All interesting questions.
Cannot be ignored.
Cannot be ignored. I would ignore at your peril because it's very much in play. All right, just a couple of other things just to mention. Of course, we've got tariff revenue. Now, these tariffs that we've seen have been enacted, or not enacted is not the right word, implemented by the executive branch, not the legislative branch. So just one point to make on tariffs. Yes, they will raise revenue. That's clearly true that they will raise revenue. Debatable how much, but they will. Can Congress take a credit for that revenue? Not technically, because the Congressional Budget Office, the official scorekeepers, they include law changes, congressional law changes, and the impact of those on their official scorecard for budget reconciliation. And so if you're asking, will the tariff revenue count? Not really, right? Because it won't show up on that scorecard. The question is, can many members of Congress, I think, rationalize the deficit amount by saying, look, I know there's a deficit number here, but there's going to be, $1 trillion of tariff revenue. I don't know what the number that is going to be, but by rationalizing, I think that's going to be the role of tariffs more than showing up on a scorecard. Let me ask you both one other question, though, because this came in a couple different ways. So let's just ask it now, and then we're going to turn to the timeline. Any of these things, the tax increases, but mostly with the tax cuts, are we talking about anything retroactive, or are they prospective only? Anybody want to take a shot at when these things would be effective? Go ahead, Dan. I can see your face.
Yeah, go ahead.
So we know that the president proposed that bonus depreciation be retroactive to January 20th, and so that's one provision that so 100% bonus depreciation for expenditures made after January 20th. Another sort of consideration there is that especially if this bill is enacted in the middle of the year, they wouldn't want taxpayers to wait until next year to make business decisions. And so I think that's one. Bonus depreciation is kind of an obvious example where that comes up, but we might see that with some other provisions, and might be an argument that taxpayers make either about retroactive in 2025 or some sort of mid-year effective date.
Yeah, and I've been getting a lot of questions about retroactivity. That's certainly true. When Congress talks about retroactivity, you've noticed there's a theme. It's that they talk about it for taxpayer positive changes, right? You rarely hear a retroactive penalty being imposed. So, for those that are concerned about, these offsets that we've just talked about, Congress 9 times out of 10, I would say 9.9 times out of 10, they really shy away from retroactive tax increases. A lot of these would be considered on a prospective basis for taxable years, beginning after 2025. And that lines up the timing with, the costs of new provisions with the revenue that's raised from new provisions as well.
Yeah. Yeah. I think that's also absolutely true. One other question before we leave this slide then. Temporary versus permanent, is the path of least resistance here? Look, they'd love to make everything permanent. They've said that. They've got the bird rule problem that we've talked about. They've got budgetary problems. They've got political votes. Is the path of least resistance here a temporary extension of all of these things, or do you think they can pull off permanence?
Well, I think permanence is really going to depend on using a current policy baseline. Arguably, you can move that forward into perpetuity without a cost. Right? So in that case, you would say permanent, naturally, because you're extending current policy baseline. It has not been, the parliamentarian in the Senate would be the arbiter of that question, whether or not that baseline that has been identified, has been identified by the budget resolution applies to just the 10-year budgetary window, or if that extends out, in perpetuity. If she makes that call, then they can do permanence. If not, one of those rules, remember, we can't increase the deficit outside of the 10-year window unless it's offset. That would make it much harder to create permanence if they were not able to extend that current policy baseline outside of the first 10 years.
And how she'll rule, case of first impression, right?
Case of first impression has not been tried before. So
go ahead, Dan.
So it's also important to remember that they'll be considering this provision by provision. And so with those TCJ extensions where there's a expiration at the end of this year and extending current policy would be taxpayer favorable, I think that's what we all have in mind as kind of the base case or central case for current policy baseline. But when we're talking about changes such as increasing the SALT cap or some of these new provisions, we could still see expiring provisions there. And so you might have a mix of temporary and permanent policy, even in kind of a complete application of the current policy baseline. I think that there's also a question of how the current policy baseline impacts how those temporary provisions are scored. Do you apply that current policy standard going forward into the future or not? So that's going to be another question that will have to be dealt with the budget chairman, between the budget chairman and the parliamentarian.
All right, let's go to the next slide and let's conclude with this and then take some more questions. The timeline. People want to know when. So I don't know. Jen, you want to take a first shot at running through what we think the timeline looks like?
Sure. No, happy to. So we know that just yesterday they passed the resolution. So we know the next step is for the committees to begin their work. Each of the committees that was given an instruction in that resolution to put out their bill and start processing it through those committees in order for them to roll it up into an actual bill that can get a yay or nay vote on the respective chamber's floor. So right now, and they have a habit of doing this. They kind of move big pieces of legislation or those resolutions right before a recess. That's when they all go home. And this week is no different. On Friday, they head out for I guess today is Friday. They head out for Easter recess. They flew out. They have a 2-week period where they're going to be out of town. When they come back, we've been getting, indications that they're going to want to start that process. Usually for a committee to mark up a bill, you need about a 48-hour notice period. So when we look at that calendar, so we know that staff is going to have 2 weeks when members are away. That's when they've gotten their instructions. They can put their bill together, and then they probably need a few days after they come back in order to make sure everything is consistent with what the principals were looking for. And they're probably targeting the end of that first week back, which is that last week of April through the first week of May for that process to begin. So if you're all wondering, okay, when can I set my clock? When will the anxiety start? It could be as soon as that week when they come back from Easter recess. Easter recess ends on the 28th of this month. So they have 2 weeks off, then they come back in. I would expect the soonest we could see a bill is the end of that week, the week of the 28th.
So
So then,
actually tax legislation. Yep. Okay, then what happens?
So once they move, we have a bill. They move it through committee. And remember, we think about tax because, we're tax people and this is a tax webcast. But all of those committees that were instructed are going to be engaging in that process simultaneously if they have their text ready. So this will be going through Congress. I believe on the House, it was 11 committees of jurisdiction. All of these committees are going to be pushing their pieces of the bill through the committee. And then they will kind of roll those all up for consideration rules. Now, how much time do they actually have, right? Between, when they come back from Easter recess, because they can do this while they're in session, right? When they have these work periods. We know that they have a pretty lengthy work period during the month of May. From the time they come back through Memorial Day is that work period where they could start that process, moving things through those House committees of jurisdiction and then moving it to the House floor. Things take a little bit longer in the Senate because remember, this is a Senate procedural rule that they need in order to pass the bill with a simple majority. That can take much longer because they have to go through the whole, behind the scenes litigation of the bird bath, making sure that the bill complies with the reconciliation rules. So, right now we've heard that, Republicans are hoping to pass the bill, at least through the House, before Memorial Day weekend. Then you have this lengthy June work period where you could see the Senate pick up the bill and start its work. The Senate could also start moving their bill in tandem in May. But it's looking like the way the process is shaping up that they're probably going to try to utilize that June work period for Senate consideration that could bleed into the July work period. They have a good number of time. They have a good number chunks of weeks where they can be processing the bill before August recess. And that's when they really want, that's a race against the clock to try to get everything done before Congress is set to recess for the month of August.
So if we're being optimistic, they can get this thing done end of July before they leave for August recess. That's probably their best case scenario. If they fail that, they come back in September. They're busy funding the government. Now we're into Q4. The next real stop sign is December, I guess. So I guess what we're saying on timing, there's a window open in July. I pay attention to that. They could get it done then. If they fail that, then I think we're reverting to December. Okay, in the 3 minutes we have left, Dan, we're going to take some questions. We've got like 10 different versions of this question, so I'll give it to you in one. Are they going to pass a bill? Are they going to do this bill? Are they going to let the tax cuts expire? Or are they just going to get this done this year? I know that's asking you to speculate, but what do you think? Are they going to find a way?
So I think they're going to be very motivated to do a bill this year to extend the tax cuts. I think that's pretty clear from what we've heard out of both Congresses. As Jen mentioned, for this reconciliation instruction, there's a window of opportunity in the June and July work period. If they don't get something done by August recess or aren't pretty far along by August recess, then we run into the government spending expiring and kind of the work that Congress needs to do, kind of must do work by September 30th. At that point, this budget resolution, which is for the fiscal year 2025, it dies if they haven't passed a bill by September 30th, and they have to start over with a new budget resolution. So I think that's why they're going to be very motivated in June and July. And then if we don't see something, then the next opportunity will probably be in December. The other thing is that we have the debt limit. Now, another thing that's unusual about this budget resolution is it also is supposed to increase the debt limit by a fixed amount. And that debt limit increase, we don't know exactly when they're going to need to do it, but it does create a little bit of a deadline that can be processed in a separate bill. So in general, this is one big bill, but they could break it into debt limit and everything else. But that also might be something they have to do. And whenever that debt limit deadline kind of fixes sometime over the summer or maybe in the early fall, that'll be another kind of motivating, another maybe deadline on the calendar. And so a kind of strategy I see they might be employing is making that deadline a deadline to pass this bill.
So I think that was a At least in my view, yes. They're going to find a way. I think they're going to find a way. It may be disappointing. It may be smaller, maybe shorter, but they're going to find a way that we will not go over the cliff. But who knows? They could fail. All right, Jen, lightning round question. One last question. Lots of people say, well, what about deductibility of R&E? What about deductibility of interest 163J? We talked a little bit about bonus. Do those get carried along for the ride too? What do we think?
Well, I think the current Senate the budget resolution provides ample wiggle room in the budgetary space for inclusion of those provisions. But at the end of the day, they're going to be pitted up against other new spend priorities because it doesn't qualify as part of the current policy baseline. So they're going to have to pay for those with their deficit instruction or with revenue raisers. So feeling pretty good about those, actually.
I feel pretty good about them. They get along.
I do too.
Bonus. Yeah. Well, look, we're right at the top of the hour. Don't want to keep you a second longer. Thank you for staying with us the whole way. Jen, Dan, thank you for presenting with me today, as well as thank you for joining us on the webcast. Also, a reminder, if you liked what you heard, we've got a podcast as well, Catching Up on Capitol Hill. It's available on your favorite podcast platform. So with that, thank you and have a great weekend. In closing, I just wanted to highlight one point if you missed it today. A bill is coming, maybe soon. And once we get a bill and legislative text dropped on us by the Ways and Means Committee, well, the nature and urgency of this conversation about the tax cliff you and I have been having since January, well, it's obviously going to change. I know you're looking forward to that, and so am I. Until then, thanks for tuning in to Catching Up on Capitol Hill, and I hope to see you soon.